Hello and welcome to our new Steps to Investing YouTube channel. My name is Simon and I'm one of the co-founders of Steps to Investing. Each week we'll be looking at a different aspect of investing and we'll be joined by a guest to discuss that, whether it's perhaps starting out for the first time investing or maybe in optimizing your investment strategy. What I would say in the interests of full disclosure is nothing that you'll hear on today's programme is financial advice. So if you are looking for personalised, tailored, professional financial advice, then head over to unbiased.co.uk where you can find a financial advisor in your local area. And I would also say that investing isn't for everyone. You need to be comfortable with the fact that investing does involve some risk and that investment values can change over time. We're going to cover risk in a bit more detail today, but I want now to introduce our guest, who is Rory Crone, who joins us in the studio. Rory, perhaps if you could just tell us a bit about yourself, what you do, and what is your interest in investing?
Sure. So, Rory Crone. I work for Thompson Reuters as one of their marketing managers there. Investing isn't something that I've done before, fully admit, total beginner. I think the biggest investment I've made is in property. Saying that, I also have my pension with work, but again, that's kind of dealt with for you. Mm-hmm. So I guess for me, what I would like to know first up is why invest versus save? I have an ISA that I pay into monthly. Safe, I know where my money is, I know it's not going anywhere. Investment seems a bit more risky. Why invest over save? That's
really good place to start, actually, and it's a question I think we should all consider as we start our investing journeys. First thing I would say is it's important to have some cash. I mean, you never quite know what's around the corner, and if you've got easy access to ready money, whether it's to make some repairs to the house or a car or whatever it might be, then you need quick access to that money. And it's often said that perhaps having 3 months or 6 months salary saved in cash is a good idea to help you with those rainy day type things. If you've got to that position and you're thinking about should I now put more in cash or should I perhaps consider investing, I mean, the first thing I would say is that actually you're taking a risk by holding cash. Cash isn't risk-free. Mm. And what I mean by that is that if the interest rate on the cash that you hold is less than inflation, that's the cost of living going up essentially, then actually your cash is already going backwards. I mean, how many glasses of wine could you buy for 20 quid maybe 20 years ago, and how many can you buy today? Probably a lot fewer, because the value of your money has essentially gone down over time as the value of things goes up. So that's a really good thing to think about is the returns you're getting from cash relative to the cost of living and how the cost of living changes. Of course, if interest rates were to go up substantially, and indeed if interest rates were to outstrip inflation, then actually you'd be getting a real return from cash, which is something that we haven't seen in this country for probably 10 years or so. Why would you consider investing? Well, investing has the potential, not the guarantee, but the potential to return more than cash, but you are going to have to accept some risk. As you said, you can get that money out of your ISA anytime you want, and you know that you can use that money. With investing, generally speaking, you tend to be taking a longer term time horizon, maybe 5 years as a minimum, perhaps even a bit longer than that. And certainly if you're thinking about investing for your retirement, you mentioned your pension, you're taking a very long-term view on what markets are going to do. And generally speaking, not always the case, but generally speaking, investing tends to outperform cash over time. So over a long period, you tend to get better returns from investing than you would from cash. Does that help sort of start your thinking?
I mean, you say it's not risk-free, so what are the risks? Really?
Well, I mean, ultimately the risk is that if you invested, let's say you invested £1,000 today in a company, that actually the value of that investment could go down in the future. So when you invest in companies, you buy a share in that company. They're listed on what's called a stock exchange, and that means that you can go along to that exchange and buy a share of that company. If demand for that company's products and services falls, or maybe that company goes out of fashion. Maybe a new competitor comes into the marketplace, or somebody else who can make the same products and services cheaper. Then the risk is that that might affect the value of that investment. Now, that's only a problem if you can't afford the time, and time's the real key here. If you can't afford the time to ride that out, maybe you need the money quickly, then the risk is that the value of your investment has gone down. And so you need to be aware of that when you're thinking about investing, that actually there is a potential for gain, but there is also a potential for loss. But you need to think about that in the context of the time you've got in order to invest.
Yeah. So when it comes to, let's say, starting out investment for the first time, what sort of pot of funds should I really be looking to start with?
Yeah, that's a brilliant question, because there are actually two ways you could think about that. One is you could think about a lump sum, as I would call it, a pot of money, and that would probably need to run to thousands of pounds to make a meaningful investment. Having said that, the other thing that you could potentially do, you talked about putting money in your ISA every month, is actually drip feed that money into the stock market every month. So about 20 years or so ago, companies in the UK started offering that service, whereby from as little as £25 a month, actually, you could drip feed money into the stock market. And what you're doing there is building up your portfolio over time. And actually, you're taking out a risk by doing that. So we talked about perhaps putting a lump sum in an investment. Well, you're then going to make a decision about the price of that investment at a single point. If you're building up your portfolio every month regularly, then actually the share price becomes less important, because over time the share price will go up and down. If you're investing each month, you're not worrying about a single price point, you're having many price points, 12 a year. Over a period of 10, 15 years, you're investing gradually. That price point changes over time. So that's one way to think about potentially investing in a smaller way, starting small. That's certainly how I started probably 20 years ago, was investing £50 a month, and then putting that in a basket of UK companies, something called the FTSE 100, the leading companies in the leading 100 companies in the UK, and actually that portfolio just built slowly, gradually over time.
I mean, it feels a little more accessible when you're doing it in that smaller incremental way.
Well, I think also it feels like you're taking less risk. I mean, you are taking less risk because you're building slowly over time. But if I said, look, could you afford to lose a £5,000 investment, or could you afford to lose £50 a month? Then I think I probably know which way most people would go on that question, because actually £50 a month over time does allow you to access and to build up steadily, rather than taking a single risk at one point in time.
And so then how would I begin to look at who to invest in?
Yeah, so this question back to you really is about whether you feel confident in picking individual companies. Would you know what to look for in a good company or a bad company?
The short answer there is no.
No, in which case then perhaps you should be considering what's called a collective investment run by a professional investment manager. Their job is to find companies for you, and they will then invest your money, my money, the money of other investors in those companies. And you end up with a little share in all of those companies as a consequence. So an investment manager, a fund manager, his job is to go out and find those companies. And they could be companies in a given geography, so he might only invest in UK companies, say, or US companies. Or they could be companies in a given sector. So there might be industrial companies or technology companies, or companies in farming, perhaps. And he has the advantage of, one, he's doing this for sort of full time, he's doing this professionally, so that essentially you don't have to, but also he has the ability to access the management of those companies, and that's really important. You know, you can read a company report and account, you can listen to, you can read in the newspapers what is happening with the company. There are people who professionally analyse companies. You can read all of that. But being able to look a manager in the whites of the eyes and ask them what they're doing with their company, where they're going, what the demand is for their products and services is actually a really important part of the investment decision-making process that you and I, as mere retail investors, men in the street, as it were, wouldn't get access to the management of Marks and Spencers to quiz them about that. So I would start there. If it was me, I would start looking at the different places in the world and the different sectors, and potentially then consider a professional investment manager as a starting point.
Okay. And how do you then go about making taking that first step to making the investment?
Yeah, so once you've decided or you have an idea about perhaps the kinds of investments you're interested in, then what you need to find is a share dealing service. They're the people who allow you access to the stock market and allow you to place a deal in the market to buy shares in those companies, or indeed in that fund. And there are quite a few of those in the UK. The internet will help you find the right solution of search engines and comparison tables and that sort of thing. Without getting into lots of detail, the two things you need to consider is at the price that those people charge, because they will charge you a fee for trading shares and holding shares with them. And you also need to consider the service that they provide. And actually that's quite difficult to do, but what do they offer? Are they offering online trading, or is it just paper postal trading, or telephone trading? Have they got any tools on the website to help you make investment decisions? What are their opening hours? What magazines and newsletters do they offer? All of those kinds of additional services that might help you make better investment decisions are very valuable in the decision-making process.
Okay. And then I guess that's great to then get started. But once I make that investment, what I'd like to be able to do is regularly track how that investment's performing. Again, are there tools out there that help me do that? Is there an app?
Yeah, and there are loads of those as well. So not only do the share dealing companies provide those kinds of services, so you can look at your portfolio literally at the touch of a button, but there are loads of other kind of information type services out there. In fact, Google shows share prices just at the touch of a button. So yeah, there are loads of ways of doing that, and you can see share price movements over time, total value of your portfolio. And actually, if you download one of these apps from the share dealing companies, you'll also be able to trade on your phone as well. So if you did want to perhaps maybe make a top up to an investment or maybe sell something, then you can actually do that on your phone now too.
Yeah, I mean, that's fantastic. In today's world where people are on the move or too busy to stop and take that time to properly look at things, but doing it on an app would be great. Yeah,
absolutely. And it most of the companies have these things. They're really easy to use. You just download one when you open the account.
Brilliant.
Just thinking about your investment time horizon, you talked about potentially 10 years. What kinds of returns do you think you could reasonably achieve in that time? What is it that you're kind of looking for?
I think for me, over a 10-year period, something like 20-25% I would be comfortable with or happy with, certainly. Is that typical, or what can I expect realistically?
Yeah, that's a difficult question to answer, because you never know quite what's going to happen in the future. I suppose what I should say is there are two elements to your return. So let's imagine we're buying shares in a company, XYZ PLC, and let's imagine we can buy those shares for £1 each. If the share price of that company goes up because the products and services of that company are in demand and it's doing well, let's imagine it goes up to £1.20 per share, there's your 20%. You've made your return over time. But there's a second element of returns from investing that's really important to consider, and that's the fact that companies pay these things called dividends. So when a company has cash, it's cash generative, it can afford to pay shareholders a dividend in the company. And that's actually like an income. It's a bit like receiving interest on your cash in your cash ISA.
Yeah.
Dividends do go up and down. The board of directors of the company decides what dividends are going to be paid, but ultimately they form another part of your return. So there's that capital element, the share price going up, but there's also an income element which you should be aware of. And if you're an income investor, and lots of retired people, for example, tend to be income investors because they're looking for a regular pension payment essentially out of their investing, they tend to seek out companies that pay a high level of income for that very reason. The other good thing about income is you can take that income and buy more shares in the company you're already invested in.
Yeah.
And so you get this thing called compounding, where the thing that you've bought allows you to buy more of it. And compounding, it has been described as the seventh wonder of the world. Compounding over time is actually a really important part of your investing because it allows you to build that portfolio, as we've talked about.
And of course, you're then investing in the company that you have faith in, that you've already invested in. So
that's right.
Just building on it, I suppose.
Yeah, it's like a snowball going down a hill. It gets bigger as time proceeds, providing, of course, the company's doing well and it continues to do well.
Yeah.
You talked about markets generally, and where does one think about investing? Do you have a sense of what kinds of markets might be interested in?
Gut feel would say technology is a sector that I would want to invest in, given its huge growth over the last few years, and future growth. It just looks like it's just going to get bigger and bigger. So perhaps the world of technology would be
That's what we call a sector, so that's right. So loads of companies fall into that sector of technology, and in fact, actually, there are funds that exist out there with a fund manager who goes and finds technology companies. What about geography?
So a gut feel would say something like the BRICS, given their growing territories. But then, of course, you've got the UK. But the UK, I would be hesitant with Brexit coming. You don't know what's going to happen. Is it the right place to invest at this time? I don't know if you've got any thoughts.
Yeah, that's a good question. BRICS, so Brazil, Russia, India, China, a kind of group of countries that have historically been, certainly in China's case, been growing quite quickly. One of the things I think you need to consider there is, there are companies there who have access to huge domestic markets, but also are increasingly trying to access international markets as well. What I would say is that not all of the companies in developing economies are run in exactly the same way, to exactly the same legal standards, what we call governance standards, as perhaps in more developing countries, so countries like the US or the UK. So you are potentially taking more risk by investing in more developing countries. Having said that, in order to get greater returns, one generally has to accept more risk. Yeah. The Brexit question is a really good one. So here we are, sort of 6 months away from the potential exit. When I talk to professional fund managers, you get a real different sense of views. Some are very pro, some are more defensive about what might happen. I think the bottom line is we just don't know right now. It isn't clear enough what the outcome is going to be. And my own view is actually that the outcome won't be clear to us in March 2019 anyway. It will be a much longer period of change that means it's very difficult at this stage to assess what the impact might be. But certainly if you look at the flow of money in the stock market, there has been over the last 2 years a move away from investing in the UK, I think because people are worried about what the potential outcome might be.
Yeah, interesting.
So I hope that answers at least some of your questions. Does it give you food for thought?
It gives me a lot of food for thought. So thank you very much for taking time and answering these questions. And I'll certainly be thinking about my investment opportunities now.
Rory, thank you, and thanks for being a guest on the show.
Pleasure.
Well, that's all we have time for, I'm afraid. Thank you very much for watching. To find out more, go to stepstoinvesting.com or check out the playlist on YouTube. Once again, thanks for watching, and we'll see you next time. Goodbye.